In this video, I'm going to show you a strategy that, for me personally, is the easiest way to invest without needing to know how to read those complicated charts we usually see in investing, without having to be glued to a screen, and without getting into weird stuff that'll keep you up at night, especially when we're talking about an emergency fund, money you need to keep safe, money you don't want to fluctuate, but that still earns you a return. What I will tell you is that you're missing out on something really big, because there's a next level, and that next level is called ETFs. And there's also something else I'll mention later on, which is really good for you to understand in detail. But anyway, I'm going to take a quick pause here. Why? Many people know what ETFs are, while others don't. Let's quickly explain. Investing in a stock means buying into one single company. But when you invest in several companies at once, well, you can do that too. But if you want to invest in 500 companies at once, it's nearly impossible. With an ETF like the S&P 500, you can invest in the 500 largest US companies instantly. Just hit invest and you're immediately diversified across all of them. It's that simple, that easy. Also, here's a key point. I'm someone who believes you don't really learn things in life just by reading or watching videos and never actually taking action. I mean, you could watch 500 of my videos or anyone else's, read every finance book out there, but if you never sit down and open an account, never deposit your first dollar, never choose your first investment, you really haven't learned anything because you stayed stuck in theory. Practice is where you really learn, because it's in practice that you come face to face with the real world, with the details, with the questions that come up when you're actually doing it for real and not just reading about it in a book or watching it in a video. This is ingrained in me because of a story I'll share. For example, in school, I had a math teacher who would explain certain things. He would give us an exercise, and when he solved it, I would think, wow, I get it. That's easy. But then when he gave us an individual exercise that each student had to solve, I was completely lost. That didn't match the example he gave, as I was stuck on the theory he explained, applying only to that specific situation. But in my case, with the specific exercise I had to work on, there were 20 different problems that had nothing to do with the original example. And that's exactly how these kinds of things work too. You can hear 20 people explain something and think, wow, I get it now. But when you try it yourself, your situation might be totally different from their experience. That's why you have to put these things into practice. That's why in this video, we're not just going to talk about the theory. I'm also going to show you in practice how everything I teach you actually works. And that's where the 4 strategies I'm going to show you in this video come in, because any of the 4 are things you can practically start doing a day. For this, we'll use the investment plan tool from XTB. Just seeing it here on the screen. And basically what this allows us to do, just like its name says, is invest in a long-term investment plan, or for however long you want, based on a specific amount of money. And generally, this is applied to ETFs, where you choose a certain number of ETFs, invest in them, invest a specific amount, and set the time frame. But that's not the most important thing. Why? I'll explain this throughout the video, so don't worry if you don't get it yet. Now, for the first strategy I've mentioned, the minimalist strategy, which is basically buying a single ETF and never letting it go. That's simple. Here, what the person does is choose an ETF that tracks a huge index, like the S&P 500 we talked about earlier. Or it could also be the MSCI World, which is an even broader index that includes companies from more than 20 developed countries. The idea is to buy that ETF regularly, month after month, no matter if it went up, if it went down, if the market is panicking, or if it's euphoric. Historically, the S&P 500 has delivered average returns close to 10% per year over decades, which doesn't mean it's going to give 10% every year. Some years it gives 25%, some years it gives minus 18%. The strategy is perfect for someone who doesn't want to complicate their life, who wants something truly automatic, and who trusts that the long term will do its job. By the way, historically, we've always talked about the S&P 500 here. And when we talk about the strategy of investing in a single ETF, it's always about the S&P 500. But there are a lot of others that have come out. And if you want us to make a specific video about that, let me know in the comments, because that's where we can talk about different strategies. There are ETFs that are only focused on European economies, and then others on emerging economies. Some people choose only that ETF. They think if the economy does badly, they'll do badly too. So they just trust things will go well. If things go well, they benefit. But if things go badly, they can't change it, because either way, things will go badly. You know what I mean? But anyway, let's move on to the second strategy, which is called core satellite, and it's one of the most commonly used by more experienced investors. But just because of that doesn't mean it's complicated. The idea is actually pretty simple. You split your investment into 2 parts. The larger part, which is called the core or nucleus, usually makes up between 70 and 90% of your portfolio. It goes into a broad and diversified ETF, like I mentioned before, such as the S&P 500 or the MSCI World, which I talked about a little while ago. And the smaller part, which is called the satellite and would be the remaining 10 to 30%, goes into more specific investments that you believe will have higher returns, like ETFs for emerging markets, ETFs for specific sectors such as technology, clean energy, biotechnology, or even thematic ETFs like artificial intelligence, which is really popular these days. What's the advantage of this? You have a solid foundation that gives you stability, and at the same time, you get to enjoy betting on sectors you believe could really take off without risking most of your money. It's like having the best of both worlds. Now let's move on to the third strategy, which is called the 3-fund portfolio. Simple, straightforward. This was popularized by a community of investors called the Bogleheads, named after a pretty historic figure, John Bogle, the founder of Vanguard and the father of passive investing. It's not important or relevant for you to understand right now who he is or what Vanguard is. What matters is that you understand this strategy involves dividing your portfolio into just 3 ETFs. The first is the US stock ETF. The second is an international stock ETF, meaning from the rest of the world. And the third is a bond ETF, which is the most stable and conservative part of the portfolio. The proportions can vary depending on your age, your goals, and your risk tolerance, but a typical distribution might be 50% in US stocks, 30% in international stocks, and 20% in bonds. This strategy is for someone who wants something well balanced, wants to be globally diversified, and wants to reduce volatility a bit thanks to the bond portion. But be careful, once again, I always have to give this kind of disclaimer so people understand what's behind it. This theory is from many years ago, and obviously, even though it's old, people say that the same thing still happens today, because what we see in history is just the repetition of the same patterns over and over. But it also helps us to have a foundation. Let's say if you want to use this 3-fund portfolio approach, you don't necessarily have to include, for example, the United States. You can choose another country if you want. It's entirely up to you. But it's a strategy that has a lot of information available online, and there are many people who use it consistently as a way to save for retirement or old age. So how do you set this up on the XTB platform step by step? As mentioned, we're not just sticking to theory, we'll move into practice now. We'll get to that a little later, because remember, I told you there were 4 strategies, and I still have 1 left to cover. If you have your ETF plan running on XTB, you're investing every month, and you want to take things a step further. Maybe you want to explore individual stocks, you want to understand the market better, or you just want a second opinion that's based on data. This is where a tool I personally use comes in, called InvestingPro. InvestingPro is basically a financial analysis platform that gives you tons of information about stocks, company fundamentals, metrics, everything an investor needs to make more informed decisions. But the part that I find most interesting, and the one I want to highlight in this video, is something called Propicks AI. Propicks AI is a set of investment strategies generated by artificial intelligence that analyze historical financial data and market patterns to identify stocks that have historically had the potential to outperform the market. Many people often ask, what does outperforming the market actually mean anyway? Well, generally, outperforming the market, just to connect the dots, is basically beating the S&P 500. In other words, if the S&P 500 returns 10% this year and I had a 12% return over the year, that means I outperformed the market. Basically, that's what it's all about. The AI behind this analyzes numerous financial metrics and weights each to rank stocks by potential. Crucially, understand what Propicks AI is and isn't. It's not a magic crystal ball predicting which stock will skyrocket tomorrow, nor a replacement for your ETF-based strategy. It's a complementary tool. Essentially, your investment foundation remains the ETF strategy you have on XTB. Propicks AI helps you find extra ideas for the satellite part of your portfolio, or helps you build a separate portfolio, as major investors do. They have their long-term portfolio, which is usually one of these long-term ETF investments. We're talking 10, 15, 20 years. And then they have their day-to-day portfolio, which is a bit smaller, but where they tend to make riskier investments, like individual stocks. And the most important thing about this is that with InvestingPro, you can also invest on XTB. In other words, the strategies you find in Propicks AI can also be implemented within XTB. I'll leave the link in the description along with a discount code in case you want to check it out. Now let's get back to the strategies I mentioned and how to put them into practice. With those 3 strategies clear, now for the practical part. You'll see why XTB is the easiest way to do this from Colombia. You don't need a code, and no finance degree is required. All you need is your ID, an internet connection, and the willingness to get started. Once you've opened and verified your account and made your first deposit, what you'll do is look for the section called Investment Plans. This is where XTB lets you build your own portfolio with the ETFs you choose, assigning a percentage to each one and setting up automatic monthly investments. In other words, you don't have to log into the platform every month to buy manually. Everything happens automatically, and that's exactly what we need to apply any of the three strategies. For strategy number 1, the minimalist one, this is as simple as it gets. Go to Investment Plans, pick an S&P 500 ETF, add it at 100%, and set a monthly contribution. Whether it's 200,000 or a million pesos, it's shown in dollars here, so just set your amount. Your plan is ready. XTB will automatically invest that money in the ETF for you. For more diversification, choose an MSCI World ETF to avoid being exposed only to the United States, but the companies across the developed world. For strategy number 2, the core satellite approach, you will add at least 2 ETFs to your plan. For example, you could allocate 80% to a broad ETF like the MSCI World or the S&P 500, which would be your core, and divide the remaining 20% between 1 or 2 more specific ETFs that would be your satellites, such as an emerging markets ETF, a technology ETF, or a thematic ETF that catches your interest. XTB automatically handles distribution based on your percentages. You deposit 500,000 pesos, and the platform ensures 80% goes to the core and 20% to the satellites, with no manual math needed. For strategy number 3, the 3-fund portfolio, the process is exactly the same. The only difference is that you'll choose different ETFs based on your plan, which under this theory means one for the United States, another for international stock ETFs, and another for a bond ETF. Simple, straightforward, easy. Within XTB, you can find many ETFs domiciled in Europe, specifically in Ireland, and this offers a significant tax advantage compared to investing in ETFs domiciled directly in the United States, because the withholding taxes on dividends are usually more favorable. As for fees, within the investment plans, you won't be charged any commissions as long as you don't exceed 100,000 euros in monthly volume, which again is way out of reach for most of us. But if you do get close, the commission really isn't that high, even if you're approaching that 100,000 euro mark. That said, if you're still watching, drop a rocket emoji below, because your portfolio is about to take off if you apply what you learned, especially if you take action. And if you have specific questions about the strategies, comment below so I can answer them in a future video. See you next time. Bye-bye.